thank you so much for joining us. Excited to kind of dive into a timely topic. So preparing for your fund audit for this year. I'm joined by Danielle Darley, who is an audit partner at Weaver. So yeah, as Danielle mentioned, she's sitting in LA. She is a certified public accountant and has been at Weaver actually for 6 years. And we'll talk a little bit more about Weaver in just a moment. And Danielle leads the West Coast team at Weaver, providing audit and accounting services to investment funds with a specialization in VC. So she kind of eats, sleeps, and dreams the audit process. So it's going to be a really good resource for us today. And she works with more than just VCs, but also with PE, hedge funds, and fund of funds. Is there anything else you would want to add by way of introduction, Danielle?
No, thanks, Belle. I think you covered everything. Just excited to be here and share some of our insights on how to best prepare for your audit.
Excellent. Sounds good. And my name is Belle. If you haven't joined one of our webinars before, I am leading our go-to-market efforts at Visible. I've been at Visible for about 3 years. Prior to that, worked at an impact investing fund and have worked at a few other startups in between. So excited to be kind of having this discussion with all of you today. So a little bit about Weaver. So Weaver's a big organization, over 1,200 professionals across the US, and has over 2,800 investment funds that they're providing services for. And the services that they are providing is assurance, tax, risk advisory, IT advisory, financial advisory, and accounting and advisory services. Anything that I missed about Weaver?
No, but I just did want to emphasize that, as it mentions here, we do 2,800 plus investment funds. It's a really big part of our practice. We've devoted substantial resources specifically to the venture capital space here at Weaver. So excited to share some of the information we've learned over the years on how to make your audit go well.
Excellent. Sounds good. And then if you're not familiar with Visible, I'll just do a little bit of introduction. So Visible is founded in 2015. We've been profitable since 2017. We actually have 2 different products. So we have a product that's used by over 3,000 startup founders. That solution helps founders fundraise and update their investors. And then we also have our post-investment monitoring and reporting tool that's used by investors. And we have over 400 funds using our platform globally. So we'll go ahead and hop more into it. Just some housekeeping though. Go ahead and use the chat function or the Q&A function at Zoom at the bottom. We'll use that to monitor your questions. We'll probably wait till the end to answer questions, but if it's relevant to the discussion we're having right now, happy to hop into it. We also would want any fund managers or other people who have joined the call today to chime in with your own insight about the audit process, so other people can learn from your experience. And then the webinar will be recorded and we'll send this out to you at the end. All right, so for today, hopping into it, we will be discussing the what, the why, and the who behind the audit process, what to anticipate for this year's audit process, how to prepare, what it looks like to establish a best practice audit timeline, and some recommended do's and don'ts from Danielle. So zooming out and just setting the stage, we're going to talk about what is the purpose of an audit. So everyone probably has a general idea that the audit is something that ensures investors receive confirmation of accurate fund financials that are verified by a third party. But Danielle, would love to hear a little bit more from you. Why do LPs care about the audit process or the audit in general, and what are they doing with this information?
Sure, thanks, Belle. So most LPs are going to be using the audit in order to gauge the success of the fund that they're invested in. And they're also going to be using that information to allocate their existing capital. So, they would want to know what is the value of their investments in the fund that they're currently invested so that they can know, what does their overall asset base look like and how can they allocate those in for the future needs. And they also may be using the audit to evaluate the success of the fund and decide if they want to make further investments with the manager. And as to why it's important if the information is accurate, well, I mean, number one, the LPs are using this information to make decisions. And so you want to make sure that you're giving them the accurate information so that they can make their decisions. It definitely can create a risk for a fund manager if the information they're providing to the LPs is not accurate, because if they then make a decision that they wouldn't have made had they had accurate information, they can always, use that, and something they could use in a potential lawsuit. But aside from the risk aspect, it's actually just also going to make you as the manager look good. If your financial statements do not comply with the typical industry standards, or they're going to stand out, a sophisticated investor, especially like an institutional investor who evaluates financial statements on a regular basis, is going to notice that. And so as far as branding your fund and your management company, you want to make sure you have good financial statements that are in line with industry standards.
Excellent. Yeah, that makes a lot of sense. So there's actually that like reputational aspect to it as well. So being known as the GP or the fund that kind of has their ducks in a row and has the audit in place, and can be trusted as a fund manager. So that makes a lot of sense.
Exactly.
And so an audit is completed, sending this information over to the LP. Who actually from the LP side is looking at this information? Is it an analyst, or who is actually doing anything with
it really could be both. It could be, on the LP side, it's going to depend a little bit on what type of LP you have, but in a more institutional type LPs, it's probably going to be both someone on the investment team that's going to be receiving the audit and looking at the financials, and then probably also perhaps someone in that team, in that investor's accounting team, might be looking at that. And so as I mentioned before, that's why when you get into people who have a lot of familiarity with looking at financial statements, it's really important for yours not to stand out. It's not a time when you want to stand out for unusual financial statements.
Yes, you just want to blend in with the pack.
Yeah.
Makes sense. All right, so we kind of touched on this a little bit, and probably the people who have joined us today have had an audit before, but also you could not have had an audit before. So Danielle, like, who needs an audit? How should I decide if my firm should get an audit this year or not?
So typically within the venture capital space, there's not a regulatory requirement for an audit, because typically venture capital managers are exempt from registration with the SEC. So there's not generally a regulatory reason to get an audit. However, what your limited partnership agreement dictates may determine that you are required to have an audit, simply because within your limited partnership agreement, you promised your LPs you would. And so if that's the case, you certainly want to make sure you do that, so that you're complying with the terms of the agreement. However, we also see a lot of managers that are not required to have an audit and will elect to do so. And I would say the primary reason for doing that is to prepare yourself for future fundraisers in which you maybe want to rate, if you only have high net worth individuals, they themselves may not require that you have an audit. But as you expand the circle of investors and you look to raise from maybe high net worth individuals who aren't familiar with you, they may want that level of assurance. And more importantly, if your strategy ultimately is to raise from institutional investors, they're going to definitely expect that you have an audit, and may even ask, did your pre-existing funds that you ran have audits? So that's generally the reason you would have an audit, even if it's not required.
Okay, excellent. Yeah, and just if people want to write into the chat, would just be curious to hear if anyone has done an audit when it wasn't required by your LPs, and maybe why you went about doing that, just so other people can kind of learn from your experience. But that makes a lot of sense for future fundraising purposes. It just looks good, and future LPs are going to ask for previous audits. So in the future, can look good to already have that in place.
Yeah, and I would say, like, we work with a ton of emerging managers here at Weaver, and we have quite a few clients who maybe we only do tax services for. But I would say probably at least around 50% of our emerging managers have an audit done, even though they're not technically required to by the terms of their LPA, just to kind of give an idea for the group.
Yeah, that's really helpful. So you said about 50%.
Mm-hmm.
Yeah. And then a question that I had is there like a lightweight version of an audit that people can do? Or is it just an audit is an audit, regardless of kind of this stage or how many funds you have?
So yeah, I mean, as far as an audit, the options are, there is what's called an income tax basis audit, and that is one option that can save in cost, because when you do an income tax basis audit, you just keep all of your investments held at basically the tax basis, which is cost. And then you're only going to record realization events when they actually occur. So it's a little simpler from an audit perspective. You don't have to do the work around valuation of your assets each year. And so that can make an audit a little bit less costly than if you had a full-blown audit in accordance with GAAP. However, you do kind of want to weigh that, because, if you are like targeting institutional investors, they probably may not consider that sufficient. They would probably want a GAAP audit, which would mark investments to fair value. Another thing you can also consider to try to keep audit costs down is the timing of the audit. So most audit firms are going to be busiest through April 30th or 120 days within year end. If you're able to accept a longer time frame for your deadline, like 180 days or 270 days from year end, you could save significantly on the audit cost, but still be able to say that your financial statements are audited.
Yeah. Okay. Yeah, that's a great tip. So just if you have the flexibility to kind of change up your timeline, can help save money.
Exactly.
The next kind of topic that I want to dive into is kind of putting the audit process into the context of this year. And this is an article that I really liked from PitchBook, titled "Why VC Valuations Look Too High to Limited Partners." So this was published earlier this year, but I liked it because it pulled in just a few different kind of maybe differing perspectives on how people are thinking about valuations in the audit process. So I'll just read through these few quotes here and then have you kind of react and share more detail, Danielle. But some things that LPs are saying is that they're surprised how long private funds are taking to write down values. So public markets are down, but funds are taking longer to kind of react and respond to that. And then GPs are saying, well, there's nothing we can do about it, or some GPs, I should say, because that's just their policy. So it's not tied directly to the public markets. And so they're not writing down their valuations. And then other LPs are considering that if they want to sell their position as an LP, secondary buyers may laugh them out of the room if they try and actually sell it for what GPs are pricing it at. So not a really realistic kind of take on the value of their fund or their investment. So lots of different perspectives here, but would love to hear from you, Danielle, kind of what's going on in the VC market and how will this affect the audit process this year?
Yeah, I think so. So, I think one thing you want to always emphasize is that valuation is more art probably than science. And so there's never like an exactly right answer to these situations. And it does require really examining each investment and considering what is going on with that specific investment. But overall, we've heard a lot of chatter about valuations being down and the expectations of down rounds, et cetera. But I can probably count on one hand the number of my funds that had down rounds in 2022, even though it was, expected that there was going to be, the public markets were down significantly already in 2022. So there was a high expectation that there would be down rounds. I didn't actually see that many of them. And even now through 2023, we're seeing a little bit more of that, but not as widespread as what you might think if you were to, see articles like this. So now that doesn't necessarily mean that the valuation shouldn't move down. It just means that we aren't actually seeing down rounds. It just means that perhaps people are holding on to their cash and stretching it out a little bit longer. So with that being said, the audit process, will probably be different for many people this year, in the sense that there is going to be a lot more pressure on audit firms to make sure that these valuations are not overstated. And so I would expect that there's going to be a lot more scrutiny around the valuations than what managers may have experienced in the past.
Yes, definitely. That makes sense, and kind of is a good segue to this next topic here. So just kind of what questions should fund managers anticipate from auditors this year? Yeah, what are auditors going to be looking out for? You already kind of touched on, but yeah, any advice for fund managers to prepare for the audit within the 2023 context?
Yeah, definitely. I think that managers are, they definitely should expect they're going to get a lot more questions around their valuations this year. And so it's really important that managers be monitoring their portfolio of investments. So I think that's the very first step, is making sure that you are monitoring how your investments are doing. So you want to be checking in with them as it gets towards the tail end of the year, and finding out, has the company had a recent round of financing? And if so, making sure you're aware of any rounds, even if you didn't participate in them. And then finding out, how's the company doing? What does their cash on hand look like? How much, how many, do they have at least 12 months worth of cash based on their current burn rate to, going into the next year? And then are they meeting their milestones or the business plan that they originally had in place at the time when the last round of financing occurred? Those are all definitely things that you should be able to answer, and that's going to lead into how you think about your valuation. So, you also will want to look, in addition to those company specific items, is looking at, for the various industries that you are invested in, how have those particular markets moved? So, if you're invested in fintech, that's one area where we have seen a significant decline in the public market. So you would need to anticipate, or consider, how does that impact your valuation? Even if your company has plenty of cash and they're doing well in accordance with their business plan, there might still need to consider, should there be an adjustment based on the fact that that industry is down as a whole. And so as I mentioned, there's no black or white answer, but it is something that you need to consider. And if you were to think that you don't need to take a markdown when the industry that you're in has seen a significant markdown, you would definitely want to be able to justify, why that is. And for example, maybe your company is just hitting it out of the ballpark and they're performing much better than the public comps that we're seeing. And because, most of the public information we're seeing, of course, is being driven by public companies, and generally, venture capital companies have higher potential for growth. And so that impacts how an investor would value that company. And so if your company is growing much faster than a market comp set, that might justify that you don't need as much of a markdown as what that same comp set is exhibiting within the public markets. You could also go and look and see, are there any actual transactions in the same industry as yours? So, maybe one of your competitors raised a round of financing this year and it wasn't at a significant down price. That's something else that might help you justify why you might not need a discount, even if the particular industry that you're in is down.
Yeah. Okay, interesting. Yeah, I actually hadn't considered it could be sector specific, but it kind of sounds like the important thing there is being able to justify maybe why there shouldn't be a down round when that sector, maybe like fintech, like you said, has changed.
Yeah, exactly. I think, a lot of in the past, or, most venture funds were always basically saying, well, we're going to hold our investments at the last round of financing. And that's for an early stage company, that probably is certainly the best indicator of value. But as the farther you go from the date of that last round of financing, the more scrutiny there would be around whether does that value really represent fair value anymore. Because if it's been a year and a half since the last round of financing, fair value is always, per gap, is always focused on, what would two willing market participants agree the price of this asset is. And so and that's why it's important to consider what's happened in the public markets and how that might impact what this company might be able to raise around that currently.
Yeah. Okay. And Carl actually wrote in a question that I think is relevant to the discussion we're having. So the question is, if there is a large difference between a ASC 820 valuation based on a public comp multiple and where secondary transactions are taking place, how should that gap be bridged from an audit perspective?
Carl, that's a great question. So, for anyone that doesn't know, an ASC 820 valuation, ASC is the fair value standard within GAAP. And so what the fair value standard would say is that both, a public comp multiple method and a secondary transaction, those are both relevant inputs when you're considering your valuation. And so what you're really looking to is, which input should I weigh the most? If I, do a public comp model and that gives me a significantly higher value than a secondary transaction that I've seen, then you probably want to evaluate, how recent was that secondary transaction? Were there any special circumstances within that secondary transaction, such as was that, the seller, was that a sort of a fire sale type of thing? Did that seller need liquidity such that they were willing to take a discount when they sold that secondary position? Those are always things you'd want to consider. And so you might come to the conclusion in that scenario that that isn't the best indicator of value and that the public comp multiple is a better indication of value. But I would always caution, that an auditor is going to see an actual transaction as an important input. And while they may not want that to be they may not come back and say you have to record it at exactly what the secondary transaction occurred at, because there often is a reason why a secondary transaction might have exhibited a discount. It is definitely something you should have considered. And you'd want to have a good explanation on hand as to, if you didn't take the price from the secondary transaction, why that is. And so again, it would go back to how your specific company that you're valuing is performing and, what are the specific reasons that led to that secondary transaction.
All right. Thanks for the great question, Carl. And yeah, anyone feel free to write into the chat. We'll either do this during the discussion or towards the end. Let's see. So next we're going to be talking about preparing for the audit process, kind of what best practice looks like. And again, a lot of you have probably worked with an auditor before, but if this is the first time someone is looking for the right auditor for their firm, Danielle, what are some important criteria that people should be thinking about when choosing an auditor? What questions should they be asking an auditor to determine if they're the right fit?
Yeah, so I think, when you're thinking about choosing an auditor, what you really are wanting to understand, there's a couple of things. One is, what is that auditor's industry experience? So for, auditing a venture capital fund is very different from auditing, a manufacturing company. And so you want to make sure that the auditor that you're choosing does have experience within investment funds, and then specifically even within venture capital, because auditing a venture capital fund could be different than auditing a hedge fund. So where with venture, there is going to be these nuances as it relates to the valuation. It's important that you have a team that understands that. So the way you could go about asking that auditor is asking them specifically like what their experience in the industry is, and then asking them, how is their firm structured? Will their team, so will the staff working on your engagement, do they have experience within venture capital? Or are they more generalist? Because, for example, at Weaver, we separate our investment fund group as its own practice line. And so all of our staff are specifically specialized and they understand terminology, and that makes it a more enjoyable experience for you, because you're not having to teach our staff, these basic terminologies, and it will also make it easier on your third-party administrator as well, because they'll be working with a team that is knowledgeable. So you'd want to ask about that. And I think then another thing is you'd want to consider is the relationship between your auditor and the third-party administrator that you're using. They're going to be handling probably 90% of the audit lift for you. So you want to make sure that it's someone that your fund admin has experience working with and is, enjoys working with. So I think it's always good to weigh in with your fund admin and see if they have recommendations on auditors that you're choosing. And then also, thinking about where are you in the cycle of your fund life, or you're managing the funds. If you're an emerging manager, are you going to need more handholding perhaps than an established manager? And so you'd want to ask that auditor, like, do you work with many emerging managers? Because it is very different to work with an emerging manager versus an established manager that has, a CFO and an accounting department and all of these things. You may need, if you feel like you might need some more hand-holding, then you want to make sure that the auditor you're choosing is going to be willing to do that for you. So you could ask questions like, what is their policy around taking phone calls? Do they charge you extra for phone calls? Like, for example, I don't charge extra for phone calls and actually encourage people to give me a call when they're working through their audit challenges. So work with tons of emerging managers, and there's a really good chance that whatever question you have, I've seen it before, and I'm happy to always provide that advice. We're really interested in seeing our fund managers be successful. It's great for us if the fund manager launches fund 2, fund 3, right? That's just another audit for us to do. So it's a win-win, and we want to see our managers be successful. So you want to make sure when you're, looking for an auditor that you ask that kind of question, so that someone will pick up the phone and answer when you need help. And then also, if the firm is deeply embedded in that industry or not, that's going to also help you out with providing thought leadership, things like this, like webinars, events in the industry. Does that firm host things that will be useful to you, help you meet other managers and potentially LPs? So typically a firm that has a footing within the investment fund space is going to be more likely to be able to offer those opportunities for you.
Excellent. Lots of good tips there to do the right kind of diligence before you choose your auditor. So thanks for highlighting all those points there. So the next thing that we're going to talk about, so kind of preparing for the audit process, you should have a valuation policy in place. Just can you do a high-level explanation, Danielle? What is a valuation policy?
Sure. So yeah, a valuation policy is just illustrating the methodology that you use to value your investments. And so you can kind of think of it as setting up a guidepost for how you're going to look at your valuation, so that it takes a little bit, valuation is very subjective, but if you have a good policy in place, it takes a little bit of the subjectivity out of it, in the sense that you've said, this is the way I'm going to evaluate my investments, and I'm going to do that for every investment. So it can take a little bit of the, I guess what you might consider cherry picking out of it, because you're going to always value every investment the same way.
And are there good resources that you know of for setting up a valuation policy, or are all valuation policies the same, or can they really vary that much?
They could very much vary, because it's going to depend on, how you're going to go about valuing your investments. I would say typically most venture capital funds are going to first rely on the last round of financing as their methodology. So, within venture, you're probably going to see a closer, less variation between policies. But then once you get past the early stage of your company, it does become more complex, because using the last round of financing is really only allowable per ASC 820 for early stage investments. So once you move past Series A, it is going to be expected that you would use more, more robust analysis. And so you would want to explain explain that in your policy. And as far as resources for setting up a policy, you certainly could, there's most probably accounting firms could help you set up a policy. We can share after this too. I have an article that I've written a couple of years ago about establishing a valuation policy and what to think about when you do that. So that might be helpful. But I think also, you could, like I was mentioning, depending on the auditor that you choose, you could probably just work with your auditor to draft something and then have them take a look at it and make sure it makes sense. I wouldn't expect for a venture capital fund that the valuation policy would be very long or very, not to say it shouldn't be detailed, but I wouldn't expect it to be, a multi-page document. And so, but it is good to have that established. This is the way that we're going to go about it, so that especially when you do run into instances where investments become stale, you know what you're going to do. And typically most, I think, audit firms are going to think about a stale investment as one that is been more than 12 months since the last round of financing. And they're going to expect a little bit more than just saying, well, there's been no rounds of financing, so we're going to hold it at cost.
Okay.
And I guess, about does the audit process change depending on the valuation policy? Yes, because the audit process is going to rely, if you have a very complex model, I have seen that where, even in venture capital, where GPs have used more complex models where they're assigning values to achieving certain milestones, et cetera. And so when you do that, that introduces a lot more subjectivity to the process. And so the auditor is going to have to spend more time trying to explain why, the more subjective inputs that the GP has used that are, I guess, internally developed and not something that the auditor can verify through public data, that is going to make the audit process more complex. So, my advice would be to, limit the use of subjective inputs as much as possible. You won't always be able to do it without any subjective inputs, but the least you can use them, the better. And the more, actual data or support you can have behind those inputs, the more that's going to add more value, more audit evidence for the auditor, and they're probably going to have less scrutiny or trouble getting the valuations past the auditor.
Yeah. Okay. And now I have to ask, why would a GP overcomplicate it and use kind of a very complex model?
I think, sometimes it can be when a GP is looking at the value, at the companies themselves, especially if they're, certain GPs have different strategies, but they feel like they know a lot about this company maybe, and they know what's going on, and they've seen them achieve all of these things, and in their mind it does impact the value. And so I think sometimes they're really just trying to make it very accurate. So it's not necessarily that they're trying to overcomplicate things or trying to do something wrong, but it can, I think sometimes they can regret that they did such a great job on their valuations, because there's just so many, if there's too many inputs to it that are very subjective, it does become challenging. And especially if it, GAAP says that you should record the investment at fair value, which would imply you could have a mark up or a mark down from the last round of financing. But I will say that, there's going to be a lot more scrutiny around whether your investments should be marked down from the last round of financing. And so, if you get into really complex models that result in large markups, you may experience more scrutiny from the auditor than had you just held that investment at cost.
Okay. That makes sense. And then I think we already kind of covered why it's important, but anything else that you'd want to add here about the importance of
I would say that a policy could definitely change over time, especially, I would actually say that a more institutionalized fund manager is going to probably update their policy every year. As once you get into the level of perhaps registering with the SEC or running that type of shop, it's probably expected that you would reevaluate your policy every year and decide if it needs to be changed. And so kind of the way you might think about that is, once you start to have realization events, if you have a realization event 6 months from year end, how did your valuation shake out? Were you pretty close to what you ended up having that realization at? And that's going to tell you how well your valuation policy is working. And so if over time you started to see that my realizations are not really matching with how my valuation model is working, then that might tell you that your policy needs some revision. And so, a more institutionalized shop is going to be that we would refer to that in the audit world as back testing. And so you're saying, I'm taking a look at how my investments, when I sold them, what amount did I realize, and how does that compare to my previous valuation? And then perhaps changing my valuation models in cases where I could see that, my model didn't pick something up that it should have.
Yeah. And it sounds like if you aren't doing that, you might feel some pressure from your LPs to do that, because to see a big change after 6 months.
Yeah, it definitely is going to depend on, what type of LP you're raising from. But, I've worked with some managers who have had, especially if the LPs that you're targeting have due diligence firms that are coming in, or ODD, they may really actually be asking, they want to see your policy. I recently had a client reach out and ask for us to help them revise their policy, because the ODD team they were working with, basically said the policy wasn't sufficient enough. And so, again, that I think is more important as you start to raise from institutional investors, not going to be as big of an issue for you if your target is mainly high net worth LPs.
Okay, really good context. All right, so let's talk about, you mentioned this earlier, kind of the importance of monitoring how your companies are performing. Can you tell us more, like what is actually included in that kind of process of monitoring your companies? And is some of the important information that you need to have on hand about your portfolio companies?
So it's going to be really important to know when was the portfolio company's last round of financing. One of the common issues that we'll see is that a manager doesn't participate in a recent round and therefore aren't aware of it. So that's the number one thing, is making sure that you have some process, like even if you maybe have just a very small position and don't necessarily have information rights, or don't necessarily have the ability to participate in follow-on rounds, that that they exist. You want to be able to figure out how some sort of methodology so you can be aware of those rounds of financing. Also understanding the performance of the portfolio company. So what's its burn rate? How much cash does it have available? You need to know that. And then just knowing how it's doing as far as meeting its milestones or performing in accordance with its business plan. So I'd say those are the top three things that you need to make sure you have a system in place to be aware of.
Yeah, that sounds good. So sounds like tracking last round of financing, whether you did or didn't participate, and then about the performance of the company, understanding burn rate, cash, and whether they're meeting the milestones or business plan that they set out. And of course, I'm going to do a small plug for Visible, and just share that within our investment data solution, investors actually can track rounds that they're not participating in. So follow on rounds, and then of course have the choice whether you did or did not participate to capture that information and have that all in place. So when it does come to the audit process, you kind of have those clean records. And then Visible is all about tracking kind of the performance of your portfolio companies. So just have an image here kind of showing our request feature that investors are using to kind of stay up to date on the performance of their companies.
Yeah, and just to follow on to that, Belle, I mean, I really can't emphasize enough like how important it is to have a system like this, or some other methodology. You obviously, there is a cost of time for you to track all of your investments, and so if you have a system like this, that should probably help you cut down on the time. But I wanted to point out that if you do get to your audit process and you end up having what we would call an audit adjustment, where we deem that maybe there was a last round of financing that you weren't aware of, and it results in a material audit adjustment, that is likely going to increase your audit fees, and it's probably also going to, so let's say in that situation, the auditor actually has to adjust the books. They're probably going to bill you out of scope because of that, and it could also then lead to them needing to give you what is called an internal control deficiency, and they would have to evaluate how severe that is. So that would lead to a communication you're getting, which could impact you in the future as you go through the diligence process. As an ODD professional might ask, have you had any communications from your auditors? And then the third thing is that I think most auditors too are going to look to, how did the last audit go? So even if there were no adjustments, but the manager didn't seem very organized and it was really difficult for us to get information from them, that's just going to feed into how much time the team has to spend on the audit, and the audit costs are driven by the hours that the team spends. And so, if have a really good system and you're making the auditor's job easier, they're going to probably reward you with lower fees. So it's just something to keep in mind.
Yes, definitely. Good tips to save funds money. So that's a good thing to share. Another good question came in from Carl. So what is the best practice for a situation where the last round of financing is more than 12 months in the past, but also the company hasn't provided any progress updates?
Yeah, so that's another good question from Carl here. So because that's a very common challenge that we see, is where GPs don't have information rights. And so what do you do in that scenario? Because you don't know how the company is performing, and maybe they aren't required to give you a financial update. I mean, my first recommendation is to still reach out to the company, even maybe you don't have information rights, but if you're asking for just very high level information, they often will give you that information, even if they don't have to. So I would start with asking them for high level information, such as like, just what does your revenue look like, from a high level, and are you meeting your business plan? Those simple questions would help a lot with the decision-making process. So when it has been stale, if you're able to find out from the company what their revenues look like, you might be able to apply to that a public company revenue multiple, and then at least justify from that standpoint that this last round of financing still looks reasonable based on the company's current revenue levels and the public comps that we see as it relates to how your company is currently doing. So, I'd say the first step would be to ask, for any high level information. If they tell you no and you can't get anything, then then what you'd probably limited to is what publicly available information is there out there. And so, for example, pitch book list information about recent rounds of financing. So you'd want to, at a minimum, do your own kind of diligence, Google searches. That's what the auditor is going to do. Make sure that you have at least identified all information that the auditor could also go out and publicly find, and then make decisions based on what it is that you see out there about the company in the public domain. And then, if you can't really find anything, another thing is looking to transactions of similar public or similar private companies, which you can sometimes find information about. And if it's a competitor or someone in a similar industry to you, that might be another source of explaining why you think perhaps, the last round of financing is still a good value. There isn't really impairment because, you can see another private company in this industry that just did a deal at a, similar valuation.
Yeah. Really good information there. And then also, I think, that seems like a sticky situation to be in when you're just not hearing updates from a company. And we've recently done a webinar and have content on just, working on the rapport that you have between you and your portfolio companies. So for me, when I look at that question, I think root cause could potentially be, do you have a good relationship with the founder or someone else on the team, or why aren't they sharing any updates? Could be lots of reasons, but could start even at like the very, initial onboarding experience that you have with your portfolio companies. Are you being intentional with building relationships with people at the company? And then for investors that are using Visible, like, how did you set up the expectation of communication and updating investors? All kind of things that we have content on that we can share in our follow-up after the webinar, but hopefully some takeaways that can help you avoid getting to that situation where companies aren't sharing any progress updates. And then another question I think we will tackle just now here, Danielle. So this came in from Andrew. And so the question is, have you audited clients that are using the Visible platform? And then how has it been utilized during the audit? And I'll quickly jump in and then have you react as well. But I've seen investors that are using Visible actually give access to the Visible platform to their auditors. So their auditors are just able to go in there and find investment records, find the documents that they need, and find the metrics all in one place. That's if you have a really open and transparent, relationship with your auditor. But yeah, Danielle, would love for you to jump in and share any experience that you have there as well.
Yeah, that's been my experience, is that, if you're willing to give your auditor access, that's really helpful because they're able to see information that's out there. And so that's going to help save you time with needing to then provide that information a second time to them. I think also, I believe, Belle, there's a feature where you can send out inquiries, so you could set up, one of the things that a lot of auditors are going to want to do is send a confirmation to the investors at the end of the year. And so you could probably work with your audit team to ask, would using Visible to administer that confirmation process work? And so you could set up the form within Visible that asks the questions that need to be asked per direction of your auditor, and then use Visible to do those inquiries, and then the auditor can be copied, or Bill, you can maybe explain the tech behind it, but I believe we can be set up where we're able to then view the responses and see that those came directly from the portfolio company, and so that's super helpful and is a really great use of the platform.
Yeah, definitely. And Andrew's actually a visible user. So what I can do afterward, Andrew, is I can connect you with our other visible customer who's using visible specifically for the audit use case. There's someone that immediately comes to mind, so I'll make that connection after the webinar, but that's a really good question. All right, so we will keep moving on here. So another kind of important thing to have in place is a timeline. And so establishing and adhering to the timeline. So Danielle, if you could speak to, what should people have been doing all this year? And then now it's November 2nd, where should people be in the audit kind of timeline right now?
Yeah, sure. So, it's still a little early in the audit process at this point. So I would say, at this point, you definitely would want to if you don't have your audit engagement letter in place, then you definitely are a little bit behind. So you want to do that and reach out to, if you're looking for an auditor, do that as soon as possible, because most auditors are probably going to start to be filling up their schedules at this point. So, but very important is you want to make sure that you have a timeline in place. And I'll repeat this over and over again because I think it's really the key to this. Key to a successful audit is, it sounds simple, but it's just having a timeline in place. And I'd be, surprised to see that, or I wouldn't be surprised to hear that many of the unsuccessful audits that have happened, if I asked a question of like, well, was there a timeline? The answer was probably no. So when I say a timeline, what I mean is agreeing with the auditor and your third-party administrator on when will the key deliverables be due. And then in addition to having the timeline, it's going to be super important that you actually monitor the adherence to the timeline, because timelines are great, but if none of the parties actually adhere to the timeline, it doesn't really do you much good. Mm-hmm. So, throughout the year, you'd want to be doing what we've got here on this first block is collecting portfolio company information. This is going to help you evaluate whether there should be any valuation changes throughout the year. So that should be something you're doing at all times. Then in Q4, so around now, you'd want to make sure that the audit timeline had been established with both the fund admin and the auditor. And you'd probably want to start to see, like, are they working on what would be called interim or the pre-audit phase, where auditors start to test some of the transactions that occurred during the year. They gain an understanding of your policies and procedures and the internal controls you have in place. They make certain inquiries. So there's a lot of work that an auditor could be doing right now. So if you've heard nothing from your auditor, then I'd suggest like reaching out and making sure that they're getting started on the pre-audit phase. Then another very important milestone is going to be January. So as soon as year end hits, you're going to want to make sure you provide your third-party administrator the valuation so that they can close the books, because they won't be able to close the books and then adhere to the timeline as when they promise to provide the books to the auditor without the valuations. And I would say that's the number one thing that I see kind of throw the whole timeline off is the TPA will say, well, we couldn't provide you the books because the manager didn't provide us the valuations, and so we couldn't close the books. So you may even be able to really get your valuations done before year end, depending on what's going on with your portfolio companies. So, not an area where you want to procrastinate around getting those valuations done. And then, by the end of January, early February, the audit process should probably have kicked off. So you just want to be aware of, well, when did the TPA and the auditor agree that the audit was going to start? Maybe mark that date on your calendar and make sure, just reach out and make sure that the auditor got what they needed from the TPA. A thing that's really important to understand is that most auditors are probably like fully booked during the time from January through April 30th, which is the standard audit deadline. So, if the fund admin delivers the books a week late, that may not seem like that big of a deal, right? They have till April 30th to do the audit, you're thinking, but it really is a big deal because they probably don't have another spare week in their schedule up until April 30th. So if the week they were supposed to work on your audit, it didn't come in, they might have been able to move another audit up, but they might not have been. And that may mean that then your audit's going to get kicked to post the April 30th deadline because they aren't able to squeeze you in somewhere else. So you can avoid all of that by just checking in and making sure, you probably want to check in with the TPA maybe a week before the items are due and make sure everything is on track. And if you do find something's wrong, I would just say reach out to the auditor, because the earlier you can communicate there's going to be a delay, the more likely they would be to accommodate that.
Yeah. One of the things that we'll touch on in just a bit is that no news isn't good news.
Yeah.
You're not hearing from kind of fund admin or auditor. It's the GP's responsibility to check in and just make sure that things are staying on the right timeline. And it was some good auditor empathy there of like, you may not think that a week later is that big of a deal, but it actually kind of messes up the whole schedule and months of work and things that have been scheduled in from an auditor's perspective. So the timelines really do matter. All right, so we're going to wrap up here on just some more best practices. And so, and one of the things that you had highlighted as important, Danielle, was just ensuring alignment on the fund admin with the request list. So what are some common items in the request list, and kind of, how should the fund manager, fund admin, and auditor all be working together during this process?
Sure. So, what probably the most common item on a request list where the fund manager's involvement is going to be needed is the investment agreement. So like the investment purchase, the share purchase agreements, and then also the articles of incorporation that go along with that share purchase agreement. You want to make sure you have those on hand and have that all organized. That's the most common problem we see is the fund manager, maybe they only have a draft of the most recent share purchase agreement because that's what they got right before they sent the money and they never got the final and that kind of thing. So just making sure that you have all of they need to be final executed agreements because the auditor can't rely on drafts. Make sure you have those on hand, make sure they're organized, and then make sure you also have the associated articles of incorporation, because that's going to be important for the auditor when they're testing that valuations, should be at the last round of financing. So ideally, best practice would be to have these all, the visible platforms. So I believe one place where you could store these documents and share access to your auditor. You also could work with your fund admin and perhaps establish some sort of share portal site where you upload all of these agreements and both the fund admin and the auditor have access. I'd say that's the best practice, is because that way there's no chance that the fund admin didn't provide to the auditor everything you provided to them. If you can just give both parties access, I think that I've seen be the most successful. However, with that, what I would say is don't data dump, don't just give a million documents that aren't needed to the auditor, because that's going to slow them down. So just give them specifically the share purchase agreements and the articles of incorporation, and make sure they're the final versions. There may have been a lot of other documents that you got as a result of a purchase or an investment, and probably the auditor doesn't really need those. And so it is going to save them time if they're not having to search through a lot of different documents. And as I mentioned before, the audit costs are mainly driven by the hours that the auditor spends on the audits. So anything you can do to make their process more efficient is going to save you on fees.
Yeah, so takeaway here is make sure it is the final and signed version of documents. And then also, when we had done our kind of prep call for this webinar, you had shared that Vector actually does a really good job in working with auditors. And what Vector does well is they do a good job of kind of sorting through what an auditor is actually going to need and providing just those documents. And that does lead to a more streamlined audit process. So just also something to kind of keep in mind if you haven't already, selected your fund admin, is be thinking about kind of how they handle kind of those service aspects as well. Anything you'd want to add there, Danielle?
Yeah, I think that's definitely true. Like having a fund admin that's experienced in venture is really helpful. And also having a fund admin that, there's varying levels of service that the fund admins are going to provide. So, as Belle mentioned, like we've had really great success working with Vector because I think they provide a little bit more than just the fund admin service, in that they will help a lot of the folks over there have been auditors. And so they know what's going to happen in an audit, and they know how to help and make sure you're prepared for that audit and flag for you. For example, if you didn't send them the valuations they're going to reach out and say, where are your valuations? We need these to close the books, as opposed to just closing the books without the valuations, which I have seen, some fund admins do. And then that's going to lead to big problems for you when the audit comes along. So yeah, just making sure that you're working with a fund admin that has experience in the space is crucial.
All right, sounds good. And some final content here. I know we're coming up on time, so I'll kind of go quickly, but when performing an effective review of the fund admin package, kind of takeaway here is make sure you're actually doing this. It sounded like.
Yeah. Yes, this is another one that's super important. Like most of, when I see audit delays or audit overruns, it's because the manager just relied too much on the fund admin to give a good package, and they didn't take a look at it before signing off. So first thing you're going to definitely want to make sure is like looking at the valuations. Did they record them as you expected? I mean, my recommendation would be is you keep your own spreadsheet of what you think your valuations should be, and then compare that to what's the total value that the fund admin came up with. And if those aren't the same, kind of digging into that, because I've definitely seen situations where the way that the value was communicated to the fund admin, they didn't understand. Maybe they applied it to some of the positions for that company and not all. I mean, there's a lot of different ways it could go wrong. But if you have your own schedule and what you expect the value to be, that should identify if that happened. Also, just taking a look at fees. Did the fees that were passed through, the management fee, if you are into the carried interest, did the fund admin record a carried interest, making sure that that was there? So, really the key economics of the fund, making sure that you understand what those are and that those are properly recorded on the package that you get from your fund admin.
All right, and then the last one, and we'll be following up with these slides, but just some fund audit do's and don'ts. Especially just highlighting the don'ts here, I think. So don't expect that the audit timeline will be adhered to if you're not adhering to it. And then we talked about this already, but don't assume that no news is good news. And then we just talked about this one. Don't forget to review the financials before actually sending it over to an auditor. So we are actually up on time, but if anyone does have burning questions, we can take one of them just now. We kind of wove some questions into the presentation though, so sorry for not leaving a lot of time for Q&A here at the end. We will be following up with this recording. If you have questions for us, can reach out to me. So my email is bella@visible.vc. And can reach out to Danielle as well. We'll follow up with kind of information for how you can get in touch with Weaver. But yeah, if Danielle, if people are leaving the webinar now and they're like, we need an audit, we're interested in working with Weaver, what's the best way for them to get in touch with you?
Yeah, I mean, the best way would just be to send me an email, and I think Belle, you'll be sending over my contact information. So just shoot me an email if you're looking for an auditor, and I'd be happy to help. We just published a blog post on how to think about valuation. So if you want more detail on that, you can email me and I can send you a link to that as well. And I think that article might be really helpful as you try to close out your valuations this year.
Yeah, we'll include that in the follow-up. So I'll be sure to get that from you, Danielle. Okay. All right. Thank you so much, Danielle, for your time. Really appreciate that you gave an hour of your day to us. And thank you everyone else for joining and participating as well.
Yeah, thanks everyone for joining, and thanks, Belle.